Good morning, everybody. I'm Alex Griffiths. I run the EMEA Corporate Analytic Group for Fitch Ratings. It's a pleasure to be at the ACT again, even if in virtual format. COP26 is happening later this year. And with that, climate change is looming large in the minds of the financial press and investors. We're seeing banks and insurance companies forced to conduct stress tests. And when I speak to long-term bond investors, they're increasingly concerned about embedded climate risk in their portfolios. So I am joined by Thomas Cansey of Vivid Economics, which is the powerhouse behind the PRI's inevitable policy response scenario, who'll take us through some of the, the key things we can expect in the next 30 years under their scenario. We also have Chris King, who is the Group Treasurer of Drax, who will take us through some of the things that Drax has been doing to transform its business model over the last few years and how it will meet its ambitious long-term targets. Before we get into the presentations, though, what I'd like to do is just ask what should be a really basic question to Thomas and Chris. And that question is why? So Drax became a world leader, again, in its ambition to become the first climate and carbon neutral company by 2030. It had already transformed dramatically in the last decade or so. What was it that pushed you to take that extra step, Chris?
So, morning everybody, and thanks, Alex. So I think for Drax, just as a quick, the 1 minute soundbite, we're the UK's leading renewable energy generator, and I think for Drax, this was a natural extension of its existing strategy. So the strategy was underpinned on the global need to transition to net zero by 2050, and Drax saw a need for the UK government but by 2030 to hit certain targets. And so in order to achieve that, one of the things that the UK infrastructure is likely to need is some carbon capture storage to help balance that need. So Drax, with the world's biggest biomass plant up in Yorkshire, has the capability for producing BECCS, or bioenergy and carbon capture storage. And so we've already, as you say, we've already gone through a fundamental transformation through 2010, going from the UK's, from predominantly being a coal generator to becoming a biomass generator. And now this is just the next stage of that journey, and it's great to be sort of pivotal and front-footed on that journey.
When you were thinking of it, though, where did the decision come from? Was it thoughts about external stakeholders' views? Was it your own innate desire to realize your mission? What was the driving force behind it?
I think, without sounding contrived, there is a need for all of us as individuals, as humans, to get to net zero by 2050, and one of those, something that we believe is fundamental to that transition, and Thomas will hopefully point to it, is carbon capture storage is going to be critical to the success of that journey. So that's it's fundamental to society. And then from a strategic standpoint, Drax is well positioned in terms of its existing infrastructure to deliver that, and on the timescales that make sense for government. And if that is then done, and working with government, you can then achieve objectives for employees, supply chain, and customers that go hand in hand with that. But I think it's underpinned on that overarching need, global need.
Great. Thomas, the PRI is an institution that tries to educate and encourage investors to interact with ESG and long-term climate goals. Obviously, you don't work for the PRI directly, but you do come across investors now and again. How has that dialogue changed over the last few years in terms of their view of longer-term risks?
Thanks, Alex, and good morning, everyone. Yes, indeed, we've seen quite a bit of change, essentially. When we set out the concept of the inevitable policy response almost 3 years ago, it was at the Global Climate Action Summit in San Francisco. And you could really see that governments were starting to act. California announced the stricter target, etc. And their investors were still in this mindset of, hey, there's some stress testing around it, and I can look at the physical risk of it and, you know, consider what 3 degrees warming would do long term to it. What was a bit of a blind spot at that point was what is actually really happening on the policy side, and what is happening all sort of in a full economy way of it. Because at that point, nature-based solutions or natural climate solutions, for example, were not really in the focus, and we were only just really starting to see some of the physical impacts. And so investors have matured quite a bit on this, and you can see, you know, from asset owners, asset managers, banks, throughout the financial industry, more sophistication in this, which is great, but also it's also partly due to the service providers offering that additional sophistication. So now you have, you know, a dozen providers that look into transition and physical risk. You have new climate funds launching. You have ESG themes really permeating this. You've also seen the regulators come in with the EU taxonomy, for example, and the TCFD sharpening on this sort of task force for climate-related financial disclosures, and now the move to the task force for nature-related financial disclosures. So all in all, I think there's still ways to go for this, but we've seen increased sophistication on how people are thinking about this. And within this, the need to go a bit further than just sort of bookend approach of saying we're moving to 1.5 degrees and hey, this will be reshuffling everything, or we're heading towards a catastrophic, you know, 3, 4, 5 degrees warming approach. So people have become a lot more sophisticated, and we see this really now starting to integrate into investment processes as in fact, well, another factor to consider, as it should be to a large extent.
Fantastic. I'm sure people are now very keen to understand what the inevitable policy response actually says is likely to happen. So do you mind taking us through the scenario, Thomas?
Yeah, absolutely. My pleasure. So with some of the slides up themselves, I wanted to walk you through in a way, what is the inevitable policy response in the first place, why we were doing this, the key policy forecasts that were coming out of this, and then how it is actually useful for financial institutions and overall. So just a brief word on sort of who's involved in this. Of course, this is commissioned by the Principles for Responsible Investment that cover, well, everything responsible investment related, so climate and beyond, of course. And as Alex already kindly said, Vivid Economics, and we're now a McKinsey company, and energy transition advisors remain the heart of this in terms of the analytics for this. And then you have various collaborators in there, from the Carbon Tracker Initiative, 2 Degrees Investment Initiative, the Grantham Institute, etc. And of course, this wouldn't be possible without key sponsors from the beginning, including the Moore Foundation, KR Foundation, the Climate Works Foundation, and the Finance Hub. And then we'll have more announcements to come about you know, strategic partners from the industry, which is going to be great later in June. Now, let me just tell you a bit of why we were even setting this out in the beginning. And I think the key point behind this is that we're really thinking that no one was really preparing the financial sector for a policy response, and how this, together with technology and market risk, affects markets afterwards. And so we're still thinking that to a large extent, what we think is the inevitable policy response to climate change is not really well understood in today's markets. And so we've seen some of the disruption happening over time. So 2 years when we set out the first one, we were saying carbon border adjustment mechanisms are becoming a viable policy instrument. And people were saying like, oh, this is a bit out there. Meanwhile, now in around about 4 weeks, the European Commission will present its proposal on implementing carbon border adjustment mechanisms. So it's about providing that forward guidance, essentially. And so we see the need for financial institutions to deepen their understanding of this one, and to have a realistic scenario around this in order to do asset allocation and any kind of financial analysis properly. And so that's why we started Inevitable Policy Response, to create that high conviction policy-based forecast. And so, as I said, what are the policies that are likely to emerge across major economies and sectors, both in the near and the long term? How will these interact with and accelerate new technologies, and therefore drive economic and market disruptions? In which sectors and geographies will these risks and opportunities manifest? And last but not least, what we put out last year is which asset classes will be impacted by this. Now, the way that it's distinctive in a way is on 6 key points. So first, as I said, it is a high conviction policy-based forecast. So this is something that we think is occurring rather than the book-ending approach. When you go to say 1.5, everything is orderly, which is a very low probability of happening at the moment. And similarly, we don't think that we will continue with stated policies in a way, and we will head to 3 degrees. So there is somewhere in the middle where we will see additional policies coming in, and this is now about how it comes in, essentially. In order to make sure that this really works, it has to be complete. So we need to cover the macroeconomy, energy and land use models, and we show how this comes across in all regions of the world, where we dive deeper then afterwards in a G20 plus 1 country, Nigeria, to say, this is how it really plays out in the key markets. To get the credibility for this one, you also need to consider the full system. So land use remains critical in this. In particular, we see the impacts, but also some of the solutions emerging in this sector. And in order to use it for investors, it is transparent. So we are transparent on the expectation for the policy developments, deployment of key technologies, such as carbon capture, use and storage, as well as negative emission technologies that become really crucial when it's the 2040s, 2050s. And last but not least, it has to be applicable to TCFD reporting and regulatory stress testing. So that not only, it's a nice scenario to have to some extent, but you can actually use it afterwards. And we've actually seen that use having being taken up. So we have 128 PRI signatories that they're using an IPR consistent scenario. We had more than 120 one-to-one briefings with investors. We of course have Fitch Ratings in this group, and using this as a base case in a ratings framework. It was used by BlackRock in a TCFD report as the core climate scenario, noting many of the points I just outlined about transparency and the inclusion of land use. The CFTC cites as a primary forecast resource, etc. And so we got essentially a really good uptake for this, saying that, hey, we do need something in the middle. So that was sort of our emission hypothesis playing out of, we can't just assume orderly transition is happening, but we're also not saying, that it will be a very delayed one in the future. So let me walk you a bit through how we actually came up with the policy forecasts within this. And so beyond the entire forecasting process, where we consulted over 200 experts for their views, where we have built on the 2019 forecast that we originally pulled out that already was considering everything that is happening within countries and announced plans. We went through 3 main buckets, essentially. So the state of policies, where is something happening at the moment? What is the current policy ambition? But also putting this in a real view in terms of what is the actual investment pipelines, what have governments committed to, what are some of the key dirty and clean assets or infrastructure developments, in particular in light of the stimulus packages, but also what is happening to trade and the trade exposure overall. Then civil society and the political economy play a key role in this. So we look also, of course, on the civil society pressures, consumer preferences, and just transition within this as well. So making sure that the policies themselves remain socially acceptable, something that people want, and on top of it are not having too many negative impacts, essentially, on the weakest in society. So they remain socially feasible to be implemented. And last but not least, all the updates to what's happening on industry and technology. So accounting for industrial strategy, industrial competitiveness as well. So no one is necessarily getting rid of their advantages in steel and shipping or in their chemical clusters, etc. And we're updating everything with the latest techno-economics. So there's quite a bit of work that goes into the policy forecasts themselves. And the policy forecasts, they cover roughly 3/4 of the world in terms of population, in terms of GDP, and in terms of also emissions. So we have the G20 included, and Nigeria, which is, of course, a fast-growing country and will become very important. We group these forecasts into 9 key buckets. So we have carbon pricing, coal phase-out, so things that cover some of the main policies within this. Further in power, about 100% clean power standards, in transport, zero emissions vehicles and the uptake of this. When we did the first round of it, we were kind of in line with what we have seen on the recent move, where we also see some of the corporate policy coming in. So really the car manufacturers moving towards electric vehicles and zero emission vehicles. But then for completeness, of course, we consider buildings, what's happening on low carbon buildings, particularly heating, clean industry, and then low emissions agriculture and forestry policies. So there's quite a bit of the buckets and a lot of the detail available for the G20+1 and the regions of how these policies are developing, when they are getting implemented, and what stringency there will be. So just to give you some highlights of this, we have here some of our top 10 policy forecasts, and just also to facilitate some of the Q&A, I'll just focus on some of the key ones in this. So for example, where on carbon pricing, we are still very much in favor of carbon border adjustment mechanisms, that they will become increasingly policy options, and they themselves help drive the adoption of carbon pricing, so particularly in the US, and the level of carbon pricing as we can go to higher prices earlier, and that helps with the overall decarbonization. On coal, we'll see key markets, India, China, and the US, acting faster on this, and in particular, stopping or reducing investment into new coal in India, as well as ending construction of new coal-fired power in China after 2025, to some extent driven by the existing net zero commitments, as otherwise they will also become impossible. The US will also, in our view, act faster on clean power, so 100% clean power standard for 2040. On zero emissions vehicles, as many of the things that we already see on the corporate policy side, aided by this, I think China, France, Germany, Italy, South Korea will move forward a ban on fossil fuel car sales, particularly as these markets for electric vehicles become also more affordable, so under just transition considerations. In industry, we will see quite a bit of low carbon requirements coming in for steel and led by steel and cement in key markets. And in agriculture and land use, we'll see further mitigation policies that come in and cover soil mitigation, as well as the overall reducing the emissions from production of crops and livestock, in particular US, Canada, and Australia, so major agricultural players. And so I won't bore you with all the details of the policy forecast, but there's like 150 pages where you can dive deeper into this. Now, the policy forecasts only are useful in the end if we know what it means in the real economy afterwards. And so the second key level of information that we put out is what we call the forecast policy scenario, the FPS. And so this policy scenario delivers the sector pathways for the major economies. And we're developing a set of value drivers for financial analysis. So this is really to understand what are the implications of all of these policies and the new technologies, what's happening to electricity generation, bioenergy production, the energy vectors in industry, the uptake of carbon capture use and storage in electricity and industry, what's happening to passenger vehicles globally as well as in key markets. And of course, last but not least, all energy vectors. So what's happening to the demand for oil, natural gas, biomass, etc. So all of that wealth of detail is coming out for COP26 in November of this year. That by itself will then include further the value drivers themselves, which we are in the process of developing right now. So something that you can plug in afterwards into your financial models and understand how it affects your portfolio, how it affects individual companies, and you can form your own financial impact view of this. We've put out the original one, so it's still accessible on the PRI's website. So if you Google the alphabet soup of PRI, IPR, it will direct you to the website, and you can see what the financial impacts across asset classes are as well. And you can play around with a sort of portfolio tool for it as well. So I'll stop here just to say that, yes, we've released the forecast, the policy forecast in March this year. We're doing a bit of an update to this, of course, as the G7 is just about to end and we see renewed commitments and in the run up to COP26. and we're releasing the forecast policy scenario as well. So you have all of these variables available. So yeah, thank you for your time, and then looking forward to the Q&A afterwards. Alex, I think you're on mute. Yeah.
Someone was bound to do that. I'm afraid it was me this time. Please do throw questions in as we go along. We'll come to them and try and get through as many as possible at the end. I think if we could bring up the presentation again, I'll give you a short bit on two questions that we get asked quite a lot. One is, in the light of what Thomas has been talking about, what are the implications and what does Fitch think about these things? And secondly, what does it mean for ratings? Okay. The slides seem to have slightly gone askew, which is something I will have to work around, but I'm sure I can manage it. So this is, I'm sure there will be a PDF of the real version of the slides where you'll be able to see things like title in due course. But what I'm trying to answer with this slide is to tell you how we think about ratings and these sort of long-term risks. So what we have here is the intersection of credit risk and ESG risks. And this takes us back to where we were thinking about how should we include long-term climate risks and all other ESG risks into our credit ratings. And when we started thinking about this a few years ago, the first answer was, well, we already do. We already think about governance. So we have a big bubble of credit risks. So things we think affect creditworthiness. And some of those factors are ESG related. The question we were being asked was, how do you incorporate ESG? So what we did was try and identify the intersection of things that people think about as ESG risks and things that will actually change the credit profile of a company. And that's that bright orange portion that you have there. What we've also done is try and say, okay, we've identified those risks. How important are they? And that's what the next slide should show us. So this gives you the result, and the result is a bit surprising, I suppose, particularly if you're thinking about some of the longer term things that Thomas was talking about. So if you look at the pie chart, we have a scale of 1 to 5 for what we call our ESG relevant scores, and all they're telling us is how relevant is this particular ESG factor to our ratings. Over 75% of those scores are 1, 2, or 3, which are basically low or essentially no impact on the rating. About 20% are medium, which is a 4, which means that in conjunction with other factors, they do affect the rating. And about 2%, only 2% is high. Now, if you're thinking that ESG is important, that starts to become a bit surprising. And then if you move over to the bar charts on the left, you can see that actually for environmental factors, we get about 3%. Having a medium or high impact. So, what you can take for that is that actually from the long-term climate risks in our actual credit ratings, there isn't yet an awful lot of impact. Why is that? It's essentially a question of time frame. So we don't have a formal rating horizon on our ratings, but if you look at one of our rating committee packages, you will see a 3 to 5 year forecast. You'll see a lot of discussion about company strategy, which is typically relatively short term. So there is definitely a shorter range forecast, a shorter range focus of those things. So if we're looking at something possibly happening in 10 years time, 15 years time, 20 years time, our conviction about what's going to happen and our understanding of how companies might mitigate that is far lower, and therefore we assign it a far lower weight, which is why we don't see some of the longer term changes that Thomas has been talking about in our ratings per se. Now, obviously, this is something we're aware of. Frankly, it concerns us somewhat. So we try to come up with something which would address this, which is where our ESG vulnerability scores came in. Our ESG vulnerability scores, next slide, please, are summed up very nicely in this slide. So what we have is the definition at the top, which is always quite useful. So they're a credit-focused view. What we're thinking about is only the impact on creditworthiness, much like the relevant scores in our ratings. We're not concerned about value judgments. It's about creditworthiness on a 2-degree scenario. So a scenario consistent with limiting global warming to 2 degrees. And in fact, that's the scenario Thomas just described. out to 2050. So there's a long-term focus to these. If you go to the graph, you can see the way that risks build up. So we've tried to look at these in terms of curves, in terms of, okay, if you continue with your current business mix, what happens to your business? How risky does it get? Obviously, if you change your business mix along the way, you can make a difference to those curves, and that's what we would expect companies to do. So the most striking curve here is the top one in green, which is Origin Energy. That's a Australian coal and gas focused player. And you can see that by 2050, the score is quite high. It's 60 out of 100, which is a relatively high risk score for this system of grading. And these are all relativities, by the way. Much like our ratings, we're not talking about absolute anything. We're talking about one company with a higher score being more risky than another company. So by the end of that period, Origin, out of these four utilities, is way at the top. But interestingly, at the start of the period, it's actually quite low down, because the markets it serves are going to be slower to punish the oil and gas and coal, electricity generation, and businesses that they operate. Next slide, please. So a few definitional pieces. Excuse me. As we go along. So firstly, if you go from left to right here, we are looking only at changes in relation to ESG factors and the vulnerabilities in relation to ESG factors. We're not trying to forecast everything out to 2050. That's impossible. We're also really focused on climate rather than the S and the G side of things, in line with the scenario Thomas laid out. Secondly, we're going to be providing these scores for sectors, which form the fundamental basis of the scores, and we'll go on to that in a second. Individual entities and their debt instruments. Thirdly, the scores are time profiled, as you saw. The other important thing is it's our analysts doing this, so we haven't got a random team of well-meaning people hired to do this. We have people who actually understand these sectors, understand the companies and businesses, and are therefore able to translate a scenario into real outcomes for companies that are likely. We use the UNPRI's inevitable policy response, which is what Thomas just laid out for you. Other than the fact that we've been through it, and actually just fundamentally what they're suggesting makes a lot of sense to us, it's the only scenario we could find that had that granularity and that depth of policy and background. Most scenarios give you an outcome. They don't give you what goes into that outcome. If you're trying to work out what the implication for a particular company is, you need to know that detail of what's driving it. So the border adjustment tax is going to be absolutely vital to understanding how, for example, the European steel sector will operate. If it's there, it's a very different outcome to if it's not there. At the moment, we're planning to do this for corporates and infrastructure entities, and important proviso, these are not ratings. So these are scores. They're very different to ratings. Ratings are based on a conviction view, 3 to 5 year forecasts. This is obviously longer term, far greater uncertainty, and based specifically around the IPR scenario. Next slide, please. So how are scores assigned? If we start on the left, the most important thing is sector. So we've got a coal and electricity transmission company here. We don't believe that a company can divorce its risk from the fundamental sector risk. So we start off with that as the building block. And the first piece of work we do is we take the scenario, and we get our analysts to work out what they think will happen to each sector and the relative risk of the sectors. We'll then go along and say, okay, for EMEA, for example, we think that this company is better positioned than average, and therefore we will take a more positive view. So we'll modify those sector scores, we'll weight them up by EBITDA to give us an overall company view. Then what we'll say is, okay, looking at this at a group level, is it large and diversified? Does it have a strong ESG strategy? And that will allow us to modify those those scores at the group level to give us the final company score. Last slide from me, a very quick example. If you could change slide, please, thank you. So this is an actual company. I've anonymized it because we don't normally give out this much data to the public. But what you can see is the sector scores in the top left. So some of them are more risky than others. Then you have the divisional split. You have the weighting then giving you the blue line on the top right, which is the unadjusted score. Now, this company we're looking at has a well-developed ESG policy. It's been implementing and transitioning for a long time, and therefore that brings the blue line down to the red line. And then finally, what we have in the bottom right-hand corner are the bond scores. So you can see the 24, 25 and 26 bonds all score around about 12, which is equivalent to the start of that curve, so the start of that red curve. But the 2039 bond, you read across up from 2039 on the graph above, and that gives you the highest score in the teens. So if you could turn the slides off now, please. I have some questions for Chris, who I'm sure you've been desperate to hear from this whole time, and he's been sitting very, very patiently. So I think you took us through Drax's history of transition and immediate plans when we started, but maybe one thing that would be interesting for people to understand is what have been the key challenges you've come across as you're trying to implement and really communicate and just work out how these things are going to work.
So I'd say, just as so Drax transitioned from being predominantly a coal generator, the UK's largest coal generator, to UK's largest renewable generator, and we announced the commercial closure of coal only in spring this year. So up until sort of Q1 2021, getting capital was, I would say, stymied by the fact that we had access. We were still a fossil fuel generator, even if that was a diminishing aspect, and we had a transition journey and a transition story. So yes, we could go and get capital. We had access to capital, but there were pockets of liquidity that were not always available. So putting that into the planning cycle was key. Now, obviously, we've de-risked that aspect, and we've got a journey that's completely different. But that has always been, one hurdle that we've come with. I think more broadly, there's just more of a fundamental question about business model and making sure that you've got flexibility and optionality to move forward. And I think that's paramount as a treasurer, but also in how you approach your capital structure. Have you got the diversity, but also how you think about derivatives, for example. How have you maintained flexibility and optionality in light of that?
And you touched on the Treasury's role there. I mean, what were the biggest challenges to your department from all of this?
So I think there's probably three aspects. So we've gone through a transformation. So Drax is around 1.5 billion market cap. We've invested around 3 billion over the last 4.5 years. So getting access to capital at a quick rate in some new technologies has been interesting, but has its own unique challenges. I think making sure that we think about the sustainable aspects of our capital structure, and now we've enshrined that effectively throughout both our term loans, into our bond process, in our working capital cycle, and even now in our derivatives. So try to be front-footed and get more proactivity, that's sharing with the business sort of the sustainable attitude, and that comes across well with investors. I think that, they're probably the key aspects.
And where have you found the most or the best reception to some of those, I suppose, less proven investments you've been having to make? I mean, who gets it and who doesn't?
It depends. So it depends on the industry type, and it depends on. So I think you have to be careful about saying, being binary about this. I think what you're seeking to do is to get momentum, and when there's momentum, you will get follow through. I think if we look forward, maybe that's a better way of saying it. The UK is looking for major transition in terms of its energy infrastructure. part of the mechanism that they're looking to do that is to get a national infrastructure bank that will help support that new technology theme and pockets of risk that banks or other financial institutions may not be necessarily supportive of in terms of their funding structure. So I would say, generally you will get progressive banks or institutions that are supportive and recognise that there is a big benefit in this and can manage that credit risk. That there'll always be some facets of any capital flow that just are not interested in new technology.
Mm-hmm. And in terms of, again, your role as treasurer, who are the key stakeholders you find yourself talking to about in respect of these kind of matters?
So from a Drax standpoint, we speak to the government, NGOs, and then fundamentally shareholders in terms of the overarching approach. I think from a treasury standpoint, we are very closely connected to our sustainable team, and then we face off to equity investors, debt investors, and also banks more generally in how we can adopt and approach sustainable themes in our financing approach more broadly.
Okay. I'd sort of led this somewhat with the idea that we might provide tips for treasurers. So what tips would you have for your fellow treasurers in thinking about these broad questions?
So I would say, think about sensitivity. So some advice I received from a retired banker was it's the unknown unknowns that you need to focus on. And whilst it's a sort of flippant statement, I think having that mindset of approach is quite paramount. And you can analyze things to death, but it's going back to what I was saying, having the flexibility and optionality in your approach is key. That's going to help support you. I'd say carbon is no different to any other transitional theme. It is a change cycle, and you need to adopt a change cycle to respond to it. And as I say, probably you covered it before, Alex, but think about your credit rating, but not necessarily today, but how the future and how that may shape up. It's going to be, today it is more relevant for the more carbon intensive industries, but there's likely to be a second tier where the next chain of medium carbon intensive industries will be affected. And I think there's, by 2025 it's expected there will be more ESG funds than non-ESG funds, and so you'll start to get equity capital flow that's starting to change its direction, and I think you'll get other debt flow will then be marginalized if it's not following a similar sort of taxonomy. So how are you thinking about that for a future funding model? And then more broadly, probably around stakeholders. So do you have internal and external flexibility, and what PR risks could you face, which are probably more substantial than the actual underlying carbon risk for many businesses, but that you want to make sure that you've captured, and your capital structure can be quite proactive in responding to that.
Great. So you told me to leave my question about how do you deal with uncertainty to the end. How do you deal with it? I mean, we've obviously got various scenarios out there. A lot of them are very different. I mean, the bank stress testing at least has 4 scenarios, all with very different outcomes. So how do you deal with not knowing what's going to happen going forward and incorporate that in your planning and your decisions?
So to go back to the flexibility and optionality are paramount. So just to illustrate that, for example, the airlines have fundamentally changed their hedging approach following the pandemic, which is to go to a more flexible approach given a different demand curve, or a demand curve that has greater volatility. So I think it's 100% make sure you do sensitivities, but it's the unknown unknown, and you don't know that, so you can't model it, and therefore having that that diversity of capital structure and that diversity of approach, and then also ensuring that internal stakeholders are set up to be able to respond, because typically when uncertainty manifests, it can do quite quickly and with quite large ramifications. So have you set up, your internal mechanisms to respond as best you can?
Great. Okay, now I think we'll move on to the sort of free-form Q&A. We've had a few questions in from the audience, which is brilliant. Do keep them coming in. You have a system where you can like things. So if a question is particularly interesting, do like it. We'll make sure we pose that to the panelists. But I'll start off with one that that we got earlier on, regards to the IEA's recent pronouncement on 1.5 degrees and their scenario that came out sort of 2 or 3 weeks ago, which made real headlines. I guess it'd be great, Thomas, if you could put that in a bit of context for us, because some of the predictions were really quite startling from that scenario.
Yeah, indeed. First of all, I have to applaud the IEA to put this out, and I think Fatih Birol's reasoning for pushing the IEA to provide this net zero economy scenario is entirely great and really laudable. I think there's still a couple of areas where, as you've seen from the feedback from BlackRock and others about the completeness, sort of really incorporating land use and ensuring that, in particular, assumptions around bioenergy availability and the impact of this are fully incorporated. I still think also there is additional depth that can be provided on the policy requirements themselves that go with this, not only in land use, but in particular in broader energy policy. So not only driven by technology assumptions, where the IEA's update has been fantastic, but comes also the long line of underestimating learning rates, in particular cost reductions in renewables, for example. I think similar, there's additional flavor to be added on the regions, in particular China. So we need to also consider what is actually happening in emerging economies. So I think that's where a bit more work might be needed. And then last but not least, also on the negative emission technologies and how we use this, where, as you can see from the IEA report, there's a lot of biogas in there. There is still a lot of CCUS deployment in various sectors available. And so, there remains some more in-depth analysis to be done on how feasible this is, and also how the economics of this develops in the future. And so there's a bit more to be done that we'll also put out under the inevitable policy response for a 1.5 degree scenario that explores some of these issues in much more detail, to provide investors with a more detailed geographical view and the right view on the policies going forward. So yeah, I mean, it's a really good effort. Definitely can only applaud them. It's the first time that they've put this really forward. So overall, really well done.
Great. We've got a top question which is being liked all over the place, Chris, for you. So I'll read it. I'll read it out verbatim. As a high impact industry, even despite the transition, are you concerned about access to funding going forward?
So it's a very poignant and interesting question. I would say probably the opposite, actually. So a couple of things. We continually seek to have diversity and flexibility in our approach to funding, but I think more generally, as we are seeking to go to negative emissions, the funding, the likely shape of both debt and equity and how it will seek to get into negative emissions technology funding is likely to see a rush of capital to those areas. So I think there's, the taxonomy needs to be clearer, and that's been developed as Thomas has laid out. But I think there's a general theme that you will start to see better or more favourable lending for being in a negative emissions technology. And there's probably a more esoteric question that goes with that, is what the implications are for one's weighted average cost of capital, but one for a treasurer to think of on their own.
I guess perhaps something that you could estimate a bit more directly. You recently renewed your RCF, which has a carbon margin ratchet, if I'm not mistaken. Are there any tips you give treasurers on what are the difficult parts of issuing one of those? And I guess it also addresses the question that we've got about what, if any, is the potential pricing benefit from it.
So I think so that the methodology that we used was understood in the organisation, and it was also very relevant. So it's the E in ESG, which acts as a generator, and so the environmental and CO2 intensity was very key. So we adopted an approach that said that is very key to us. Yes, we explore the full spectrum of the sustainable regime, but that will be our primary focus, and then to tailor that to our existing reporting requirements. So I think the key is to try and get the reporting framework as in line with your existing approach, and then to tailor something that's meaningful in terms of target trajectory, that you can stand behind in terms of delivery in future years. In terms of the actual financial impact, it is helpful. It's not overly, it's not huge, but what it, if anybody who has a target, you don't want to miss your target. So, behavior change is far greater than the actual financial impact.
I mean, we're certainly seeing a lot more ESG focus more generally, bonds and instruments being issued across the spectrum of things that we rate, and we are starting to really this year hear that it is making a difference to pricing. So obviously we're not the people that really monitor that, but certainly the word I'm getting is that whereas this was a bit of an unknown factor anywhere outside the Nordics a couple of years ago, it's starting to have a real impact on access to capital. I think we've hit time. I wanted to just address one further question very quickly. So we were asked what our views are on scope 1, 2, and 3 emissions. We've done a lot of work trying to understand how some of these pieces of data are put together and what we can use them for. I think it's possible to overestimate carbon per se if you're looking at assessments for long-term risk from climate change and the transition. What we've tried to build into our vulnerability scores is really a more direct and just very nuts and bolts impact of what actually it means to a market. So if you're a cement producer, for example, if you're emitting a lot of carbon, yes, that's a fact. That's just what you do. You can find ways to reduce some of that, but you're never going to eliminate it from the process, or it's going to be very, very hard with today's technology. But the question really isn't so much how much carbon are you producing as who is going to pay for the cost of that if you get carbon pricing. So if we have to build, for example, seawalls or offshore wind or onshore wind, the whole carbon transition is going to take a lot of investment. We will need a lot of cement. So that's a very simple example of a company's ability to potentially pass through some of these costs onto its customers versus something else like a coal-fired power station where it's been painful to the people in the industry, but as a consumer, you probably haven't really noticed the massive transition that's gone on. Your electricity still works, your bill's gone up a bit, but that's it. So understanding really behaviors around some of these changes is important to getting to a meaningful outcome, and that's something we're trying to focus on. Thank you very, very much, Thompson, Chris. Thank you, everybody in the audience, and for your questions. There is a load more on Drax's ESG plans, on the IPR, inevitable policy response, and on our vulnerability scores as well on our respective websites. So please do knock yourself out, educating yourselves even further. Thank you very much. Have a good rest of your day.